Good morning, everyone. Thank you for joining us on this webinar. My name is Abiodun Kerikwe, Managing Director, AfriInvest Research and Consulting, and I will be moderating this live session. This is the AfriInvest webinar presentation for the Nigerian economy and the financial markets review 2021 and 2022 outlook. The presenters are Omobola Audu. He'll be presenting the global macro review and outlook. Damilare Asimiu, he is a macro strategist. He will be taking us through the macroeconomic and monetary policy section of this presentation. Segun Adams will be presenting the fixed income review and outlook. Aminat Ibidu will be presenting the equities market review and outlook. Before we begin, I have a few housekeeping notes. Today's session is being recorded to be available for viewing post-webinar. If you have any questions for the presenters, please use the chat feature in the Zoom webinar. You can also submit a question via our email, research@afriinvest.com, for presenters to answer after this session. If you have any technical questions, please reach out directly to me via the chat function on Zoom. Each presenter today will have a total of 10 minutes for their presentation. If one of our presenters completes their presentation before their 10 minutes is up, there may be time for a question from attendees. However, we will hold most questions until the end of the session, and I will then read questions out loud for the presenters to answer, as time permits, within a 15-minute window. Now, let's please welcome our first presenter, Omobola Audu, who will be presenting the global macro review and outlook section to us. Omobola Audu, good morning. Great to have you here. I can see you're already on the call.
Yeah.
All right. We can just dive right into it. You have the floor.
All right. Please just to confirm, everybody can hear me.
Yes, we can.
Okay. So we observed that the pandemic dynamic worsened towards the end of the year as new variants considered to be more contagious emerged. In Europe, the number of new cases per million people dropped to 40% between the start of 2020 and September. But by September to December, the number of new cases rose by over 400%, which coincided with the discovery of Omicron. A similar situation happened in Africa, where number of cases dropped by over 54% before rising well over 200% within the last 3 months of the year. Now, with the current vaccine divide, where around 92% of the population in low-income countries are yet to receive vaccines, compared to around 30% in high-income countries, global growth prospect for 2022 is considered to be modest, as we'll see in the next slide. So in this slide, we see that the global economy is expected to recover by around 5.9% in 2020, largely driven by growth expectations for advanced economies and key countries in emerging economics and developing economies. Full year, US is supposed to grow by around 4 to 6%, and China around 7 to 8%. Now, in 2022, we believe the global economy will consolidate some of the progress we've seen so far, although at a lower pace and growth will be divergent across regions due to issues surrounding vaccination and fiscal and monetary policy withdrawals. We noted that in a lot of advanced economies, most of the central banks have noted the possibility of withdrawing monetary support in terms of hiking interest rates to combat with inflation. As we'll see in the next slide, global trade in 2021 bounced back sharply, growing by well over 10%. Next. Growing by well over 30% due to the reopening of economies and the low base year effects. However, in 2022, we expect growth to be halved, around 4.7%, as the base year effect wins and extended supply side constraints. Notably, in last year, shipping costs closed 2021 around 200% higher on a year-to-date basis, which just reflected the increasing costs that economies have had to face in terms of trade. In terms of the global oil market, global oil prices averaged around $70 per barrel in 2021, which was backed by various disruptions and OPEC plus support to manage supply levels. Interestingly, price rose to around $80 per barrel during the year, the first time that has happened in well over 3 years. In 2022, we expect prices to remain around $70 per barrel, backed by increasing oil demand expectations. As we say, in 2022, in terms of global oil demand, is expected to rise well over 100 million barrels per day. Now, moving on to the performance of financial markets. What we basically saw was divergent performance, largely due to different policy choices and expectations around interest rates to curb inflationary pressures. The MSCI World Index gained about 20% last year. The frontier markets rebounded, growing by about 16%, while emerging markets recorded a loss by about 4.6%. Which was largely reflected towards the end of the year as investors started to price in expectations concerning interest rates. Now, having spoken about some macro trends in 2021, we will now look at some key issues that will shape the economy in 2022. The first is in the energy industry. Now, we are likely to see 3 key trends gain further pace: decarbonization, decentralization, and digitalization. Basically, the renewed policy commitments by global leaders in the clean energy industry, especially China and US, have reinforced new commitments to reduce carbon emissions and to reduce global temperature level. China plans a 40% target of clean energy by the end of 2030. Another trend we are likely to see this year is the race for the future of money to pick up. Now, 87 countries representing around 90% of global GDP are exploring the possibility of a central bank digital currency, compared to May 2020, when we had just around 35 countries exploring this. Now, 9 countries have fully launched theirs, including Nigeria. And some of the factors that we're likely to see to play a role in the increasing development of central bank digital currencies revolve around financial inclusion, cashless policy, and remittances, especially for the low-income countries. Moving on, we have identified other key sociopolitical themes that will shape 2020, most especially in terms of global cooperation and conflicts, migration, election, climate change, and poverty reduction. In terms of election, a number of key countries are expected to hold their elections this year. In November, the US midterm election is supposed to hold, and notably, no sitting president has been able to win majority seats in that election. Also in France, the presidential election is supposed to hold in April, and also since 1988, no sitting president in France has been able to be re-elected. At this point, I would like to say thank you for listening as I hand over back to the host to continue to lead us.
Yes, thank you, Omobola Alde, for that presentation. At the moment, we don't have any questions from the audience, so we'll just move on into the next section of this presentation, which will be anchored by Damilare Asimiu, who is the macro strategist for AfriInvest Research. Damilare, I can see you already on the call. Please.
Yes, thank you very much. Thank you, Abiodun, and thank you all participants. So a bit of a retrospect on 2021. 2021 was the year that marked the recovery of Nigerian economy from the contraction that came about in 2020 as a result of the pandemic. And thus far in the first 9 months of 2021, we saw the economy rebound in terms of GDP performance by about 3.2% on average, which are strong enough to offset the contraction of about 1.9%. And by our own estimates, despite the slack in the economic recovery that might have come in Q4 due to the emergence of the Omicron variant of the pandemic, we think the growth in Q4 will still range between 1.6 and 2.3, which on average should bring the full year growth to about 2.7, as you can see on your screen to the left-hand side. This invariably will be the fastest growth since 2015, though if you net off the effect of the contraction in 2020, it's just about 0.7% growth. But again, it's an improvement from where we're coming in 2020. Also, the recovery we saw in 2021, or that will be consolidated by the Q4 GDP number when it's published, has been largely driven by the non-oil sector. And of course, that is much expected because in the global market for oil last year, despite the fact that prices were high, Nigeria's production capacity was affected in 2 ways. One, there is the OPEC output cap that prevented Nigeria from meeting its budget target of about 1.86 million barrels per day. So on average, last year, Nigeria was producing about 1.56, which was also affected by shorting on some of Nigeria's major oil terminals. And as you can see in the pie at the middle, oil sector contribution to the GDP fell from 8.7 in 2020 to 7.5 in 2021. But we think this trend will improve in 2022 as the repair works on the oil terminals, oil terminals to be precise, have been completed in December. And I'm talking about the performance of the non-oil. The services sector was actually the brightest spot for the economy last year. And of course, this is not surprising given the fact that a lot of business activities were moved to digital channel, were moved to online. So we saw the high city subsector to be precise, leading in terms of contribution to growth, growing about 7.2% on average, same as trade, about 10%. And for the agri sector, performance was a bit underwhelming, same as industries. Of course, the concern around the slack in the agri sector performance cannot be divorced from the high level of insecurity that is on rampage in most of the agrarian communities. Also, the industrial players were heavily hit by the mild FX crisis that happened last year. We all recall that we started 2021 with an exchange of 379, but it deteriorated to 410 when the CBN decided to adopt NAFEX rate in April. And the case in the secondary market was even more worse than that. So that takes us to the dynamics in terms of general price level. So in 2021, about 8 months in 2021, between April and November precisely, price level decelerated, at least on year, given NBS reading. Yes, in December, we saw a little bit of uptick in price level to about 15.6. But again, the dynamics in terms of inflation rate last year was, the dynamics in terms of what the NBS reading in each of the months was, and the experience of people who go out there, you and I, that hit the street to buy things was different. We can all testify to the fact that the price of certain commodities at the beginning of the year was nearly double by mid-year or towards tail end of the year. So a lot of Nigerians felt that the continued decline in inflation was actually not realistic. But what actually happened is the fact that there was base year effect in the calculation of the price level, so which invariably supported the deceleration we saw in the 8th month. But in real time, prices was actually still on the uprise, because on average last year, the month-on-month reading for both food and core inflation, which are the sub-component of the headline inflation, rose on average by 1.3 and 1.1. So which means in real time, price pressure was still high in each of the months. And going into 2022, we think that while we expect the base year impact to begin to dissipate from Q2 2022, so which on average will bring average inflation for 2022 to about 13.6. Of course, that's still very high, far from CBN's target of about 6 to 9%. We think that the pressure in 2022 will not really be as much as what we saw in 2021, due to the fact that a lot of normalcy is now, normalcy is being returned to the economy. And that takes us to our external position. So from our own estimate, we think that the Nigerian economy is already on course to booking a deficit current account balance. As of half year, we're already at about deficit of about 8 billion in dollar term. And from the chart you see on the left-hand side, you observe that the last time Nigeria ever had a current account surplus was 2018, when both trade and transfers were in positive region. And then the current account balance has been in the negative region, largely because on the goods trade sub-account, we have been posting deficits. And as of 9 months of this year, MBS data shows that in terms of trade, Nigeria is posting about a deficit of 8 trillion. Our exports about 13 trillion plus. While in terms of imports, we've imported over 21 trillion worth of items. And largely, what we import the most is refined oil and lubricant. So invariably, we think that for 2021, by our estimate, we still have about current account deficit of about 9.1 billion, export of about 31.8, and export of about 22.7 and import about 31.8. But by and large, we think that the good thing is that the coming on stream of the Dangote refinery later in 2022 could actually be a good one for the country, at least to save between 15 and 20% of our FX exposure or goods importation. Because if we're able to get this commodity locally, then the pressure in terms of external balance will reduce. So in 2021, we're likely to see a further moderation in the external balance deficit. And by 2023, we think that Nigeria may return to a positive current account region. And that speaks also to lead us to the part on capital importation. Yeah, so from our observation, we saw that foreign investors have continued to distrust the Nigerian market. As of 9 months of 2021, total foreign capital flow to Nigeria was just 4.5 billion. That is less than what we mobilized in each quarter in 2019. As you can see from the chart, 2019, Nigeria nearly raised about 24 billion in foreign capital flows. In 2020, due to the pandemic, we were only able to amass about 9.7 billion. But as of 9 months in 2021, it was just $4.5 billion. I would think the best we can get in the last quarter is about 1.5, which will bring the total to about 6 billion, which is far adrift of the level in 2019. And the reason for this is not far-fetched. The exchange rate policy in Nigeria continues to give a lot of foreign investors concern, especially given the fact that we have a multiplicity of exchange rates. And also, the bitter experience of some foreign investors in 2020, you find it because repatriating their fund during the peak of the pandemic, still continue to weigh on sentiment. So given the fact that 2020 is our pre-election year, and there's really no more change in the exchange rate policy, I would think that the foreign capital flow may still remain very low going into 2020. And that takes us to the performance of the 2021 budget. The numbers you're seeing here, in terms of the actual number, speaks to what the economy did in the 11 months of 2021, according to data we were able to get from the Ministry of Budget and Planning. So in terms of the assumption, the only assumption that was to Nigeria's favor in the 11 months was the oil price, which nearly doubled the budget benchmark. In terms of production, I mentioned earlier what affected our production capacity. OPEC supply cap to Nigeria, which is just about 1.68. So that's about 0.2 lower than what our budget assumption was. And also, there were shorts in on some of Nigeria majors oil terminal, which made us not to be able to even produce up to the OPEC level. And in terms of budget performance as regards revenue and expenditure, we'll see that there that revenue as of 11 months was just 5.5 trillion. That's about 26%. 26% adrift of the prorated number for November, and about 32% adrift of the full year target of 8.1 trillion. But when you look at that in terms of expenditure, as of 9 months, as of 11 months, we've done about 94% in terms of expenditure at 12.6 trillion. And the fact that our revenue, actual revenue, falls short of the actual performance helped to widen the deficit gap. The planned deficit for the whole year was 6.4, but as of 11 months, we've seen deficit widened to 7.1. We think by full year, that deficit number should be really about 7.5 trillion. So which means the government had to rely more on ways and means and other borrowings to be able to support the budget. And that takes us to the trend of FG's debt profile. We can see that it has risen from 27 trillion in 2020 to 31.5 as of 9 months 2021. And that is even outside of the ways and means support from the central bank. So if we lump up both FG issue debt and ways and means, total FG's debt as of 9 months last year is about 47.6%, which is about 30.9% of GDP in 2020. Also, for the 2022 budget, the FG actually planned to spend 17.1 trillion, which both in Naira and dollar term is Nigeria's biggest budget. But again, when you look at the driver of the budget, of the expenditure plan, that's where there is a concern. Because here the budget itself is not big. 17.1 trillion in dollar term is just 41 billion. And if you divide that by Nigeria's population of about 200 million, that is just $107 per person. So if you bring that back to Naira, just about 55,000. That's what the government is planning per head in 2022. But again, the problem there has to do with how the budget itself is divided in terms of which share goes to revenue. It goes to recurrent capital or sinking fund. So recurrent expenditure is governing about 40% of the budget, which is a bit concerning. Capital expenditure is just taking about 32%, which should take more so as to drive inclusive growth. And debt service share of the budget at 22.6% is also very huge. And if you look at each of the numbers, recurrent debt and sinking fund, capital expenditure, as well as statutory transfer, they all represent an increase from the prior year, at least by 2016, 9.8 and 73% respectively. And if you look at the revenue assumption, oil proceeds is expected to come in at 3.6 trillion in 2022. We think this is overly optimistic. That's about 77% higher than 2021. Even 2021, the oil revenue had underperformed by 46% as of 9 months. So which means as of 11 months, we've only realized barely above 1 trillion, and the government is expecting to see 3.6 trillion from the same oil, where they don't have capacity to control the output. So we think the oil revenue may actually not, our revenue target may actually not be met. But in terms of non-oil revenue, we think some initiative by the government may actually support this improvement, which we'll see in the next slide. Though in 2021, non-oil revenue have actually done more than projected by about 18%. And with the with the new initiatives that the federal government has been able to draw out from the financiers, we think the non-oil revenue, even if it will not meet this increase, it will come close to it. And talking about the highlights in the Finance Act, there are 4 items that caught our attention there. The FG now has expanded its tax net, which is the source of its revenue. We now have company income tax on foreign e-commerce businesses. About 6% will be charged on their turnover on businesses that's related to Nigerian markets. So if you visit any online platform where a transaction takes place and it involves exchange of goods and services, there's a charge of 6% on that turnover. The federal government will begin to take. So this is expected to support non-oil revenue, or let me say tax revenue. And also there's also a new tax on, we call it sweetening tax on beverages, beer. Tax on carbonated and sweetened beverages of 10 naira per liter. This is actually very minute if you compare it to the excise charge on beer alcohol that takes almost 40 kobo per CL. So a 10 naira per liter means that you have to take 2 50 CL bottle of Coke or Fanta before this charge will come in. But where the concern is here, or where we can see some funny thing, is that in Nigeria, especially in most cities, we don't play with lower denomination again. So instead of increasing the price of a bottle of Coke to 110 naira because of the 10 naira tax, we're likely to see the price going up to 150, because in most cities we've tried to ignore or put aside our lower denomination. We also have a science and engineering infrastructure levy, 0.25% of profit before tax of banking, ICT, telecommunication, aviation, maritime, as well as oil and gas player whose annual turnover is up to 100 million and above. And also the capital gain tax on shares disposal, 100 million and above, has been rolled back. So it means for any share sale that is up to 100 million and above, FG will take 10%. So all these are new initiatives by the federal government to rake in revenue. Nonetheless, in terms of our outlook for 2022, which actually formed the topic of our outlook, a mix of bloom and gloom, there are a lot of factors that we think will, at best case, support the economy to grow at about 2.9%. So which means our expectation for the economic performance this year, the best case, is even stronger than that of 2022, because we think oil price will remain above $68 per barrel. Oil production will improve now that our oil terminals are back. I would think the services sector will continue to support faster growth. I also believe that pre-election spending at some point will help to improve aggregate consumption in the economy, as well as liquidity flow. I would think that improved implementation of the capital budget, at least about 68% of it, will support the base case. Why anything above this will move us towards the best case, and a worst case scenario will come to play if we have each of these driver or supporting factor coming below the base case level. So that takes us to the monetary policy review and outlook. So in 2021, CBN accommodative stance, which began since 2020 when the pandemic struck, to a large extent actually paid off in some instances. We saw credit to private sector rising in 2021 by about 40.5% to 34 trillion. And we also saw the rebound of a high number of labor elastic sector like trade, manufacturing, and construction. All of these sectors rebounded strongly. As of 9 months, they had growth in excess of 5%. And also the regulatory forbearance of the CBN to banks was very supportive in terms of keeping non-performing loan numbers very, very modest. Non-performing loan number sits at 5.3% of October, which is just 30 basis points above the regulatory threshold. I mean, in 2016, non-performing loan situation was worse than this because there was no regulatory forbearance from CBN. So Nigeria had learned from 2016 experience, and that helped us in managing the 2020 pandemic crisis very well. And also, the economy is on track to reaching CBN's GDP target of 3%. However, CBN's policy action in 2021 could not save Nigeria in terms of exchange rate. And 2021 will go down in history as one of the years when Nigeria have experienced highest level of volatility. We started the year with exchange of 379. At some point, due to lack of capacity to defend the naira, due to weaker inflow relative to outflow as the economy reopened, the CBN initially devalued the exchange by 8% to adopting an FX rate. But the peak of it was when CBN imposed ban of FX sales to BDCs, which further mount pressure in that market segment. As of we saw price exchange at the secondary market rising from about 405 at the beginning of 2021 to almost 568 at the end of the year in the secondary market, and the pressure remains like that because foreign capital flow remains weak, and CBN have also reduced supply to this market segment. And there are a lot of items that cannot access FX at the official rate. At least the CBN has about 45 items that are being barred from accessing FX at the official rate. So all these factors are played out last year when the pressure on the naira, was very intense and exchange rate dynamics was not favorable. However, going into 2022, our scenario in terms of monetary policy dynamics is also in threefold. The base case, which is actually what actually played out yesterday when the CBN held its monetary policy rate, we think that at the base case, the CBN is likely to maintain policy stance throughout H1 first, because the benefit of raising interest rate at this point is quite small compared to what the consequences could be, because we're hiking interest rate now to move ahead of the dynamics in global systemic central bank may actually not be to support Nigeria economy in so many ways. First, our growth is very fragile. The real growth, if you net off the effect of 2020 contraction, is just about 0.7% to 1%. So increasing interest rate or raising MPR will signal interest rate hike and will increase cost of borrowing to businesses, which also have impact on capacity to employ. But in terms of inflation, perhaps the inflation in Nigeria is more of structural concern. So increasing interest rate may actually even compound it, because when business doesn't have capacity to borrow due to high cost of business, then production will be low, which invariably will also impact on price. So basically, we think that largely, at least in the first half of the year, may actually play within our scenario 2, which is to maintain status quo, and unless the more benefit that we have on that part than thinking of a policy hike. That brings me to the end of the macro presentation. I believe at the end of this, at the end of the whole presentation, we'll have time for any questions that might have been asked. Thank you very much.
Thank you, Damilare Asimiu. Please add, if you have any questions for Damilare, please add them in the chat box. And we'll be able to answer some of them during the Q&A section at the end. But any questions we can answer during the Q&A section will be taken care of via emails. That said, some of the interesting highlights from Damilare's presentation provide context around what we should expect for the macroeconomy in 2022. This then leads us into the next section of this presentation, which is the fixed income market review and outlook. And this will be anchored by Segun Adams. Segun Adams is on the call currently, and he will be on the call just right away. Segun, the floor, please take the floor.
Yeah, thank you, Abiodun, and good morning, ladies and gentlemen, and good day wherever you are in the world. So right away, we'll go into the fixed income presentation, starting from the global scene. In 2021, monetary conditions were easy. This was due to the evolution of the pandemic, which is ongoing, and then central banks were wary of a sudden withdrawal of support to the financial markets and economy. They didn't want to risk a taper tantrum. On the back of that, global debt stock rose 1.9% in the year up to Q3 2021, where it peaked at $296 trillion. This was largely driven by emerging market government debt because governments across emerging markets sought to plug budget gaps and also help support their economies in the period. So given that, as we'll see in the next slide, we saw that largely speaking, monetary conditions were very accommodative. While we noted that this policy support had helped economies sort of steer their ways out of economic downturn or recessions, it also came at the cost of higher inflation across the world due to the mix of supply chain bottlenecks. We recall the case of the blockage in the Suez Canal earlier in the year, and also weather-induced supply chain disruptions. We recall the shortage of computer chips, super chips during the year, and a whole lot of that. So we saw Sofit financial system liquidity meet with pent-up demand in the year, as well as supply chain bottlenecks, and this piled inflationary pressure in the United States, where there are across UK and Europe, where inflation targets, they have a long-run target of 2%. We saw inflation rates shoot up to 7% in the United States as at December, and in the UK, we saw 5.4%, and across the European area, Euro area rather, we saw 5.0%. These are historic levels and unprecedented in decades. And so that prompted some tilt towards a hawkish bias. We saw at the end of last year, Bank of England took a hawkish position. And then in 2022, we're expecting the Feds, who are also meeting today, they have also guided to 3 possible rate hikes before the end of this year. The European Central Bank has committed to unwind this asset purchase, while Bank of England, we expect that they should effect 2 possible rate hikes before the end of this year. We think that these systemic global central banks will sort of, the direction they tilt will sort of influence other central banks to follow suit, as we expect it to affect capital flows. But we think that while we're expecting a synchronized hawkish tilt this year in 2022, we think that emerging markets bond remain a good bet. As we can see historically, emerging market bonds, which are proxied by the JP Morgan emerging market bond index, have sort of continued to rally despite periods of rising rates in the United States, which are in the little bubbles you can see on the chart. So coming to the domestic scene, 2021 was also a very unique year. We saw that there was a reversal from the historic lows in the Nigerian fixed income space. We saw that average yield on treasury bills, bond rather, surged by 4 and 5.4 percentage points respectively to 4.5 and 11.6% each, which sort of brought yields closer to their historical levels, as you can see on the chart. And this was due to a mix of shift in market dynamics and also the influence of regulators in the market, particularly the act by PENCOM asking fund managers to recalibrate their exposure to fixed income instruments. That led to sell-off in H1. Also, CBN hiking OMO rate at the first auction in February, selling the 1 year around 10% from almost double what he sold at the auction preceding that, and that sort of like induced a bearish pressure across the curve, especially in the first half of the year, where the CBN also began. Please, the previous slide, where the CBN also began its discretionary debit. So as a result of that, the Nigerian local bond underperformed emerging market pairs. The S&P FMDQ index fell 15.0 in 2021 compared to a downturn of 1.7 in the for the JP Morgan Emerging Index. Next slide. Thank you. On the corporate issuance space, we saw that corporate issuance is slowed down in 2021. This was due to an uptick in yield environment, and given that in 2020, the very low interest environment encouraged a lot of corporates to actually issue papers and also refinance existing ones. But we think we anticipate that there will be more issuances in the first half of this year, given that we are expecting a huge sort of maturity. Actually, 91.9% or 92% of the entire maturity commercial paper space will come in the first half of this year. But we sort of look at, broadly speaking, in 2022, what will be the sentiment of corporates towards borrowing, and we sort of feel that the shift in focus to electioneering activities, given the peculiarity of this year, will make corporates very hesitant to borrow as they begin, some of this uncertainty begin to impact on their decisions. Next slide. Across SSA, we saw a slight bearish tilt in 2021, which was not surprising, given that there's a very low vaccination rate in across the region, poor access to vaccines, as well as persisting sort of imbalances in the economy, despite the recovery we had seen in the year. So we also have a mixed outlook this year. We think that while the economies will sort of the growth will sort of be positive, we still think that these external and fiscal imbalances will persist amid the hawkish tone from systemic central banks. Next slide, please. Looking at 2022, the big question is what direction will yields go? And then we sort of looked at historic data to answer this question, although we admit that this historic data is just give us sort of like a guide, but of course, they are not guaranteed for future outcomes. When we look at the historic data, we saw that pre-election years are also characterized by bearish pressure, given the uncertainty that we're seeing that year. But these are the four main factors we'll be looking at in the next, or before then. This is our projection for in terms of liquidity profile. We think that we're expecting total supply of 7.2 to 7.7 billion trillion rather in 2022, while that is total paper supply compared to an inflow that we estimated around 7 trillion. In the next slide, we highlighted the four main factors we are looking at. We look at supply and demand factors. We think that the financing need of the government will deepen. Like my colleague Temilare said, we expect the deficit to actual deficit this year to grow as much as 10 trillion, given that the projections are somewhat unrealistic given what we have seen and what we know based on analysis. We also discussed the hawkish global sentiment in the global session, which my colleague Omobola did justice to. Also, we think that the change in fee structures in the fixed income space will sort of impact net yield. We think that net yield will sort of increase to compensate for that, as well as the election of certainties, which will be priced into the market. Next slide. So in terms of strategy, in 2021, our portfolio was in the red, but we know it was a very bloody year in the market. Forgive my French. 2021 was a very bearish year. However, our portfolio returned, we still beat the S&P FMDQ index, given that our modified duration returned negative 13.4, smart euro bond negative 8.8, and passive bond negative 11.2, compared to the 15% decline. Next slide. So what we are looking at in this year, given our outlook for a bearish outcome, our overarching strategy is that players should stay at the short end of the yield curve, while new investors or traders short sell. Based on our modified duration, we favor a tilt towards that short and medium end of the curve. For the SSA space, we think participation will still be a healthy. We think that recovery in the region will still persist. And then for our passive bond portfolio, we maintain that existing investors continue to hold. And for new investors, we recommend playing in short-dated instruments like treasury bills and And that brings me to the end of my presentation. Thank you very much.
Thank you, Shego, for that interesting and excellent presentation. This provides context for the fixed income market in 2022, bit of strategy on where or how investors should play the market. With this, we should proceed into the next or the last segment of the entire presentation, which is on the equities, delivered or anchored by Aminat Ibidu. Aminat Ibidu is currently on the call. You can have the floor.
Thank you, Biodun, and good morning, everyone. I'll be taking us through the equities market review for 2021 and our outlook for 2022. So the equities market in 2021 underperformed compared to 2020, although it returned a 6.1% gain, which is a little higher than our 6% projection at AfriInvest. We attribute this performance to a mix of both positive and negative drivers. For the positives, some market stimulating corporate actions, impressive earnings release, and oil price recovery both sentiment. While negative news around COVID-19 variants, rising yield in the fixed income space, persistent FX issues, and lack of significant positive catalysts dragged performance in some months in 2021. So these drivers reflected in the market activity, which I'll be speaking to in the next slide. Activity level in the Nigerian equities market was depressed as both average volume and value traded fell. And looking at market activity on a monthly basis, we can see from the charts that January, February, March, and October recorded the highest trade. The first quarter increase was driven by the spillover effect of the 2020 rally and investors taking position for dividend. While in October, the high trade recorded was due to oil price rebound to $80 per barrel and mop-up of FBN shares by a local investor. So the effect of FBNH mop-up, the fact that the mop-up had on the market reinforces the domestic investors' grip on the market, highlighted in this slide. So available data from NGX showed that local investors' stake in the market improved 8.2% year-on-year to 1.3 trillion, though institutional investors command a bulk of this size. Meanwhile, if we look at foreign investors' participation in the market, we continue to see a free fall due to persistent FX issues, which we expect to continue. And this caused a net outflow of 20.3 billion between January to November 2021. Moving on to the top gainers and losers for 2021, we can see Eternal, CWG, Suno Assurance lead losers, while we also saw tickers like Boa Cement, Nigerian Brewery record losses due to weak earnings. On the other hand, we saw penny stocks like Lasaco, Vitafoam, Champion Breweries lead the gainers following improved earnings and the market pricing into a possible merger between Champion and Nigerian Brewery after Enikin, which is the parent company of Nigerian Brewery, took over 15% of Champion Brewery. We also saw oil and gas stocks like Seplat and Total post impressive return due to the rebound in oil prices. This oil price rebound trickled down into the oil and gas index performance when we compare to other indices in the market. The oil and gas index ended as the best performing index for 2021 with a 52.5% return, and this was followed by the AfriInvest ICT index, which tracks stocks in the telecommunication and technology space, which posted a 14% gain, backed by investors' interest in MTN, following its public offer, the 5G operation license, as well as the PSB license granted to both MTN and Airtel Africa. Likewise, we saw insurance and the insurance, banking, and consumer goods indices report high return for 2021. And on the other hand, we saw the industrial goods index ending as the lone loser for the year due to losses from Boa Cement, which offset positive returns that we saw from Dangote Cement and WAPCO. So if we look at the market in terms of valuation, we can see that Nigerian market trades at a discount compared to peers. And if we look at the NGS as the Nigerian market as a standalone, we can see that the average PE for the market rose to 11.4 times from 9.4 times that we saw in 2020, as average market earnings grew faster than prices. And when we just oppose this with peers in the BRICS region and MSCI index, we can see that Nigerian market is trading at a discount, and we expect this to remain the same. So far, our FX policies remain the same. So moving on to our 2022 outlook for the equities market, we expect to see positive and negative catalysts dictate the direction of the equities market performance in 2022. And looking at it from a global scale, the anticipated interest rate hike from systemic central banks and headlines around COVID-19 could cause capital flow reversals from emerging markets, and specifically worsen the outflow we've seen from foreign investors in Nigeria. So for more localized drivers that we expect to move performance in the equities market in 2022, we expect improvement in fixed income yield to lure investors into the fixed income space, and this would then inflow into the equities market. Also, as Segun and Damilare highlighted earlier, 2022 is a pre-election year, and this will cause investors to stay on the sideline with a let's see how it goes approach, and this would weaken sentiment in the market. Nevertheless, we expect to see positive earnings releases from corporates and also dividend payouts for some corporates that have shown consistent dividend payout history, and this will be a bit of good tidings for the market. All of these factors informed our prognosis of a 7.3% return in a base case scenario and a 6.4% loss in a bear case scenario for 2022. Also, these drivers shape our equity strategies for 2022, which preaches searching for value amid cautious optimism. Before we look at our 2022 strategic portfolio, a review of our 2021 strategic portfolio showed that all our portfolios underperformed the market, save the dividend portfolio, which gained 75.1%. As I earlier highlighted, our recommendation is based on a cautious approach, and we preach a diversified approach towards the market. And to this end, we constructed our 2022 portfolio, which has the value, growth, dividend, and banking portfolios. For investors shopping for undervalued stocks with strong earnings potential, we recommend our value portfolio, which has Danksem, Okomu Oil, and Zenith. While for investors shopping for that have long-term horizon and have preference for income-generating stocks, we recommend Danksem and Okomu Oil. We highlighted in our banking sector reports that the banking sector is a resilient sector, and due to this, we've constructed a portfolio that picks strong stocks in the banking sector. And due to this, we have I beg your pardon, Guarantee Trust Bank, that's GTCO, Stanbic, Zenith, UBA, Access, and Fidelity for that portfolio. For the investors that would like to enjoy high dividend yield or stocks that pay high dividend, we recommend Danksem, GTCO, Guinness, Zenith, Vitafoam, Access, QTix, FCMB, and Triple G. So overall, we expect the equities markets to end on a positive note, although politicking ahead of 2023 election and lack of key catalysts could dent this optimism. Thank you very much.
Thank you for that excellent presentation, Aminat. A very interesting and beautiful wrap-up to the whole presentation. So with this, we are officially at the end of the webinar, and we can now take Q&A. We have a couple of questions already on the Q&A box, and also a few on the chat box. So I would quickly run through the couple of questions on the chat box. The very recent one is from Barbara Barugi. I hope I pronounced that correctly. Instance in 2022, given the underlying political economy. The perspective was pretty much split into two. One for the first half and another. Damila represented perspective on the monetary policy environment, and pretty much two angles. One for the second half of the year. Okay, apologies. There seems to be just a temporary glitch, but interestingly, we are back, or I am back. So basically, I said that the outlook for monetary policy is that we actually do expect monetary policy to remain stable for the first half of the year, regardless of the fact that there is a global trend now that all of the globally systemically important central banks are pretty much tapering some of their accommodative policy decisions from 2021 and are beginning to hike rates. And we think the central bank does not have sufficient headroom to sort of increase the interest rate environment or basically change their monetary policy posture for the major part of 2022, given some of the structural bottlenecks we've always dealt in the economy, depending on the performance of certain economic variables, for instance, GDP performance, continued recovery or positive performance from the oil sector, and how the FX environment basically shapes out, that then would inform how the monetary policy authority rates for the rest of the year. That said, I will go into the next presentation. In the next question, that is from what is the outlook for inflation and how will it impact returns? This is coming from Adeyemi Oyenekon. I think I will merge that question with another one. Okay, so we've already taken this. That's a question on the monetary policy. Okay, so we should take that question on the standalone. The next question on the chat box is around the oil sector and the performance of the oil GDP. Damilare, are you able to take the question outlook for inflation?
Yes. Okay, yeah, can you hear me now? Yeah, so I think the question is, what is the outlook for inflation and how will it impact returns? Yeah, so basically this year, like we projected, a while ago, our base case scenario for inflation is the fact that it will average about 13.6%. So which means that the effect of structural bottlenecks on price level will remain. Yes, we expect the federal government to double down their effort on insecurity, especially in terms of attack as we approach the election period, because they want to make at least all the states to be in a very accommodative state to allow for election to take place. But again, we have production shortfall. We have weak capacity to meet domestic demand. So we think price level will still remain high in terms of importation pressure. And also, yesterday we just had the government saying that they're likely to postpone the subsidy removal plan, which was actually part of our scenario anyway. Our best case scenario, based on what we have on the slide, was predicated on the fact that we are less likely to see the subsidy implementation coming into play. The details of this will be in the report will be released immediately after this webinar. So at best case, we actually expect that inflation will not be lower than 13.6%. And if you look at the yield on most of our instruments now, I think the 10-year instrument is just about 12.5%. So yes, we expect yield to improve. We expect yield to improve in 2022 between about 100 basis points to 150 basis points. But we think for fixed income players, this may not be sufficient enough to offset the impact of the inflation when you look at it from the perspective of a real return. If inflation is expected to average about 13.6, so which means at worst case, it could go higher than that. As a matter of fact, at worst case, we think inflation will be about 14.4. So with yield not likely to cross 14%, I'm using the 10-year FGM bond as a benchmark now. Our real return may still not be attractive for fixed income earners. But again, everything about investment has to do with your risk appetite. So someone who is risk averse will rather take whatever is being offered in the fixed income environment than wanting to play in the equity space. Also, given the fact that effect of systemic constraints is making a lot of companies not to be able to deliver on strong dividend numbers. Although there are some companies with dividend yield that is in excess of about 10-11%, but they are just very few. So which means for a risk averse individual who has also not entered the equities market at a time prices are very low to the fair value, fixed income asset may actually still be a very good asset to trade on this year. But by and large, the inflation outlook is not really encouraging because it's still expected to sit far ahead of the CBN target range of 6 to 9%, and also Nigeria historic average inflation rate of about 11%. So averagely, inflation in Nigeria in the last decade is about 11%, but we are expecting that it will average above 30% this year, which is very high. So risk level, play a lot of role in what the return will be. But we just advise that investors should play smartly and have a diversified portfolio. Thank you. So we also have in the chat box okay, so there is another question from Kehinde Obemiata. I hope I pronounce your name very well. So your question is, with the planned divestment of some IOCs, what assurance do we have that GDP from oil will improve in 2022? So concerning this question, right, even before most of these IOCs make their intentions or plan known to everyone, we've seen a lot of Nigerian-owned companies too strategizing and trying to position themselves for investment opportunity in this space. And our expectation on the improvement of the oil GDP in 2022 is actually not really centered on the divestment agenda of these IOCs, because this divestment is not going to be sudden. It's a process. And most of these divestment plan will span about 2 to 3 years. So it won't have a serious shock on the Nigerian economy this year. And also a lot of local players are already positioning themselves. We've seen Seplat in recent time expanding its production, production line. I mean, divesting as well, adding a lot of cleaner energy, business line to its operation. So we think that the performance of the oil GDP this year will be buoyed largely by two things. One, we think that the average production for Nigeria will improve. Like I mentioned earlier, in 2021, average production was about 1.56 million barrels per day, at least as of 9 months. And by November ending of last year, two of Nigeria's oil terminal that was shut for over 8 months due to repair works and stuff have been fully fixed. So we think that this will help support Nigeria improve crude oil production, and with projection for crude oil price to average above $70, we think this will be good. Also, we also think that yes, some of the most interesting part of the recently passed Petroleum Industry Act is now being postponed, which has to do with the subsidy removal. But we think there are some reforms, especially as it has to do with attracting investors in the oil and gas segment, that will also support the improvement of the oil GDP, because now there is some level of clarity on how foreign investors can come in, or any investors in terms of oil and gas can come in and play in that space without suffering from multiplicity of tax like what we used to have before. Because before, many of these IOCs are exposed to very high tax. Some of these have been addressed in the new PIB. So all this, then considering the fact that we are coming from a low base, the oil GDP have been in contraction for the last 7 quarters. So by and large, with any decent improvement in 2022, surely the contribution of the sector to the GDP will actually be positive and better than that of 2021. Thank you.
Thank you, Damilare, for that apt response. We have very interesting questions on the Q&A window, and unfortunately, we are perhaps 5 minutes or 6 minutes behind time. So I see questions from Akintoye Oyelakun. I see from Adewale Adedokun. I see from Samuel Haga. I hope I pronounced that right. You would not like to listen beyond our initial schedule. Please expect to see an email from us with our responses to these questions on this episode of our Nigerian markets and economic review and public presentation. We look forward to having you at the half-year review session. Thank you, and do have a blessed year.